Hi, so welcome back. We've now got the Where Now for Logistics panel, which will be very fascinating, I'm sure. First of all, we're going to have a 15-minute presentation from Kevin Mofid, who is Head of Research of Industrial Logistics at Savills. So, and then we get on to the panel. Just a reminder for questions in the room, just to click the button, pull the microphone towards you so I can hear your question. Okay, welcome up, Kevin.
Perfect. Thanks, Richard, and good morning, everyone. Pleasure to be here to talk about where we see things heading for industrial and logistics. I'm Kevin Mofid, Head of Industrial and Logistics Research for Savills in the UK and Europe. I've been talking and writing about warehouses now for almost 20 years, I guess. Back then, nobody wanted to speak to me, and now I get invited to all sorts of conferences and so on to give my views on where things are going. Well, it's all very interesting at the moment because people, when I'm being introduced at conferences, people say Kevin has the answers. And at the moment, I don't really have the answers, but I have a series of observations that give me clues as to where the market is heading. I've been slightly over optimistic, I think. I've got almost 30 slides to do in 15 minutes. You will be sent a copy of the slides, but what I may do is skip over some, and we'll use that to talk about some topics during the panel discussion. I'm not an economist by trade. I trained as a town planner originally, but I am reading a lot of economic literature at the moment, speaking to the Savills in-house economists, and using that information to help me inform my views on where the market is going. And I just thought this was an interesting observation. Again, 2022, the word of the year, perma crisis. We all know why, various reasons. I was speaking to an investment agent recently who told me, all I want is a normal year. And I don't think we're going to get one for quite some time. And clearly that has an impact on the industrial and logistics market. And I talk about industrial and logistics. And for me, the term industrial is a real, legacy term. Because actually, if we look at occupier demand over the last 10, 15 years, actually, 60% of occupier demand comes from the retail sector in some way, shape or form. It's either online retailers, traditional retailers, logistics companies serving contracts for retailers. So, the health of the retail sector really is what's going to drive our sector. Now, there are areas where that is changing, and I'll come on to that, talking about nearshoring, reshoring, those sort of things. But as I said, this was a really good slide. It came from our global economist, Oliver Salmon, and it's the Citibank Economic Surprise Index. And I was surprised because I'd never heard of this index up until recently. But it's brilliant because what it does is it looks at the deviation between what economic forecasters were forecasting and then the reality. And what's really interesting is that when the index is in positive territory, it means that the economic performance exceeded what was forecast, and when it's in negative territory, it means that actually the reality has been worse than what was forecast. And if you look at the red line, the Eurozone, okay, it started well and then it started to taper off. And again, sentiment has been generally improving. And again, back in the UK, the Chancellor there looking relatively happy, and with some reason. You can see the PMI trending upwards and the impact on GDP, less pronounced than it may have been. And Oliver discussed this in his talk about consumer confidence and this detachment from people's view on the wider economy, but their view on their own personal financial situation. And that's probably due to the tight labour market and so on. But why is all of this important? As I've already mentioned, logistics is driven by retail. And this chart, I think, is interesting because it looks at retail sales volumes, not retail sales values. And the two things are very, very different when you're talking about logistics, because logistics is a volume game. And you can see there the trend, and this is looking at the 12-month change in retail sales volumes. So you can see that volumes are down. Actually, if you look at this in absolute terms, it's broadly where we were pre-COVID. So, not necessarily as amplifying as that 12-month change on this chart makes it seem. I'm getting asked a lot of questions on the future of e-commerce. Where is it heading? And so on. This is data from Statista. They forecast out. By the way, Statista are forecasting that the online retail share in the UK will be 35% by 2027. You may or may not agree with that. We talked about the saturation point in the next panel. Of course, there'll be one. But for me, I still firmly buy into this story. And one of the reasons, a very simple reason, is demographics. A 40-year-old of today who spends a reasonable amount of money online is going to spend more online when they're 50 than a 50-year-old of today. So that demographic piece is going to continue pushing online retail forward over the next decade. But if you just look really interestingly here at the top, the shaded lines that I've put in, sorry, the dotted lines, where's that growth going to come? Fashion, food, electronics. Fashion, astonishing growth that Statista are forecasting in online retail sales. Okay, I'm going to intersperse this now with data on the UK and Europe. And as I said, I've got half of my slot to do this. So interestingly enough, in the UK, we've had 3 amazing years of take-up over 50 million square feet each year. Q3 2022, take-up fell below 10 million square feet in a quarter. Okay, that's not as high as it was during the pandemic, but actually it's at the upper echelons of the average that we would have expected pre-COVID. So take-up is still strong. It's just not as strong as it has been during the pandemic period. And if you look at Q1 of this year, what's really interesting is that we actually only saw 2 deals for units over 400,000 square feet. Why is that important? Because you're not getting that amplifying effect. If you look at the deal volume, the absolute number of deals, actually it's broadly stable. It's just that we're not seeing those huge deals that are skewing those numbers forward. What is interesting, however, is the balance of take-up. What type of buildings are people taking? And I just want to draw your attention here to the red line. The red line is the proportion of take-up that's second-hand. This is important, particularly in relation to ESG and so on. Back in 2022, we actually saw the lowest amount of second-hand space ever taken. Granted, there was limited supply. So there is a supply point here, but I would love to believe that there's an ESG angle here as well. Occupiers are looking at more at modern buildings that are cheaper to run, better located, and actually they're this flight to quality that we talk about across every sector in commercial real estate, but we're beginning to see it now here in logistics as well. Moving into Europe, again, similar trend to the UK, amplified take-up during the COVID pandemic period, which has then trended downwards. I've just this morning got the data for Q1 in Europe, and it's coming in at just over 7 million square meters. So where does that put us? It puts us again around 2019 levels. So not too bad, all things considered, considering where we've come from over the last 2 years during the COVID pandemic. I mentioned nearshoring, reshoring, and I just want to talk about this in a little bit more detail. Ever since Q2 2020, there has been any number of surveys that you could find. Everyone talking about nearshoring, reshoring, friendshoring, supply chain resilience, all of this type of stuff. It was having no impact on our data. It was just noise. It was just filling up the headlines. However, that changed in 2022. In 2022, we observed the highest amount of manufacturing-related take-up ever in the UK, 11.5 million square feet. Usually, it averages around 7 million square feet. So there is now concrete proof that we are seeing demand from those manufacturing-related sectors. I would put it into 3 buckets. I would put it into the pharmaceutical supply chain, the food supply chain, and the automotive supply chain. So really interesting demand drivers. And it's not just about the impact of COVID that's brought this into the boardroom. There are other factors keeping it there. Labour costs. I was in Poland recently, and one of my Polish colleagues delighted in telling me that it's now cheaper to hire a forklift truck driver in Poland than it is in China. Supply chain resilience, the term friendshoring. A quarter of our trade is conducted with high-risk countries. Sustainability, ESG. It is carbon expensive to move containers around the world. So again, there are other reasons why this is going to be a lasting trend rather than the noise that COVID brought to it. That's just the Google data for nearshoring and reshoring. And again, some Eurostat data on inventory accumulation and the importation of intermediate goods. Intermediate goods, what is that? Components. So again, we've had to change the scale on these charts to accommodate what's happened here. And again, we produced an index, which I won't go into now. You can download it off our website. But again, this trend is going to benefit Europe, particularly Eastern Europe, and it's also going to benefit countries like Mexico, Canada, and so on. And again, I just talk about this. The colours don't come out great on the big screen, but again, you can just see in the bottom right that manufacturing-related take-up increasing. Now, it is increasing, but what's decreasing is the online retail. That's the pink in the middle. Where's that going to go? Remains to be seen. And I'm sure we'll talk about it in the panel. However, the more things change, the more they stay the same. If you look at Europe as a whole and where take-up was in 2021, that's the middle ring, and where it was in 2022, that's the outer ring, it's remarkably stable. People are taking space in the same places. Now, if you really, really buy into this nearshoring, reshoring, friendshoring story, it's going to be really interesting to put this same chart up in 5 years' time. Will we see countries like Spain, Poland, other parts of Central Europe take a bigger piece of this pie at the expense of Western Europe? Or will it remain broadly stable? Because actually logistics is about where goods are going, not where they're coming from. Jury's out, we'll see. However, where's take-up going? We've done a new piece of research, which we're going to launch in the next couple of weeks. We track every single requirement for space in the UK from occupiers. And we've correlated this with take-up 9 months later. And there's a really strong statistical correlation. You can see the surge, it's the dark blue line in occupier requirements during COVID. And then you can see a steady decline. We get a take-up ratio of around 26% from requirements to deals. This suggests to me that take-up in the UK this year is going to be somewhere in the order of 30 to 35 million square feet. So coming down from the 50-ish million we've had over the last 3 years. However, what's really interesting is if you look at Q1 23, we've seen a 57% increase in occupier requirements in Q1, which suggests to me that we should start to see take-up rise at the back end of the year. I just want to talk about supply. Again, I think it was mentioned in the panel, about what's different this time. Go back to 2009. 2009, we had 100 million square feet almost of vacant space, a vacancy rate of almost 25%. Back then, the average level of take-up was 16 million square feet a year. Things are fundamentally different now on that supply side. And that's what's created this tension that's driven the rental growth, both in the UK and across Europe. Yes, we've seen supply rise over the last 3 quarters. It's gone from a 2% vacancy rate up to 4.6 now. But do I see a situation where we're going to get to 2009-10 levels? No, unless we see catastrophic failure and second-hand supply increasing. But I don't see that happening. I'll skip over that last slide. I just want to talk about this one. One of the reasons why I don't suspect supply is going to rise dramatically is speculative development. Build costs, pricing, land values. Speculative announcements have fallen dramatically. So far this year, we've seen 2.4 million square feet of speculative announcements. The same period last year was over 7 million square feet of announcements. So that means the pipeline is going to be heavily constrained into 2024 and 2025, again, keeping those vacancy rates low. Now, the rental growth forecasts have been downgraded, as you'd expect. These are forecasts which we buy in from a company called Real4. Now, this is based on a demand-led econometric model. It's looking at consumer spending, unemployment, all of those type of things. What this fails to see, however, is the supply side dynamics. And if we look at this chart, apologies if you're colorblind, but this is one of my favorite ones, because actually, again, the panel before mentioned this, the devil is in the detail. The devil is getting under the skin of the data, not looking at the national trends, because actually, if you look at this chart, the green areas are where you've got less than 1 year's worth of supply, even taking into account the development pipeline that already exists. So what I'm saying, okay, at a headline level, vacancy is rising. Yes, we've got a significant amount of spec completions this year. Yes, second-hand supply has increased. However, if we look at this data, scratch the surface of it, particularly at the bigger box end, and in smaller markets, you still have these pockets of undersupply. And that is where you will capture rental growth. So it's not going to be uniform. It's not going to be uniform. Again, it's detail, detail, detail. And again, in Europe, similar pattern. These are rental growth forecasts from Capital Economics. They're suggesting 1.6% a year rental growth. And again, if you look at Europe, the vacancy rate is 3.1. Again, rents have never increased when vacancy has been above 12%. So the point I'm trying to make here is, yes, the macro forecasts on rental growth are worth looking at, but I spend much more of my time looking at vacancy pipeline, because in my mind, that is going to be a better indicator of where rental growth is going to come from. And we've seen this across Europe. These are just two markets, London and Prague. Prague's had rental growth of over 20% over the last 5 years. It's got a vacancy rate of 1%. London, similar. Rents have increased by almost 100% over the last decade. Capital markets, it may surprise you to learn that actually across Europe, capital markets investment volumes last year was still the second best year ever. And it wasn't as front loaded into half one as you may have imagined. It was about 60-40 in terms of that balance. Clearly, it's not going to be the same this year. In the UK, we had 1 billion invested in Q1. You have to go back to 2009 for a lower Q1 in the UK. But we are seeing pricing shift. That being said, in the UK, we've moved our prime yield. It was at a low of 3%. We moved it to 5%. We've now brought it into 4.75 in the UK. Not there yet in Europe. And again, that'll be a topic of discussion for our panel. I have gone slightly over now, but I just want to talk about some more mega trends. We did our logistics census. We've done this for 6 years now with Tritax. And it's a fascinating piece of work. And we get some really interesting results. We get over 100 responses from occupiers, really valuable data in terms of what's going on. What are occupiers concerned about at the moment? Rising costs, as you'd expect. Rising costs of energy, rising costs of fuel. But again, talked about in the first panel, availability of labour. And we are not yet seeing anything from our survey that suggests occupiers are meaningfully looking to come out of space. In fairness, this was done before the mini budget, so it's a snapshot in time. It'll be interesting to see what this shows when we do the research again later this year in our 7th year. However, I just wanted to talk about this because it's really, really interesting, in my opinion. Occupier investment plans for 2023. We've asked this same question for the last 6 years. And we ask occupiers, what they're concerned about, what they're going to invest in. Right at the bottom each year has been ESG. Every single year. If you ask the investors and developers the same question, it's right at the top. There's a real mismatch here between what the investor development community is saying and what the occupiers are saying, because they're concerned about the bottom line. Take Next as an example. A huge amount of their emissions are in their cotton supply chain. Yes, real estate is important, but there are other things to worry about. And you ask that to retailers, refrigeration, transport, fuel, these are all big things. So it's interesting to see how that plays out, and we can discuss it. But again, I think, as I've ably proved, I'm a bit of a data geek, for want of a better term. And I've got every EPC for every single warehouse in the country in a database. Again, I think it's fascinating, because if you look at the bigger box logistics, actually the EPC profile is quite good. But if you look at the smaller logistics buildings, urban logistics, last mile, actually that's almost 2 billion square feet of property in the UK. And I think around 70% of it is C or below. So is that a problem or an opportunity? Something to discuss. So look, I want to get straight into the discussion and the debate. As I said, I'm not an economist. The data is changing every single day. To me, there are pockets of optimism. That labour point being one, consumer confidence being another. Low vacancy rates in the market are going to be key, because that's going to drive rental growth. But it's not about vacancy at a macro level. It's about vacancy at a sub-market level, and it's about vacancy at a sub-building level. Capital markets are stabilising. We're expecting a much stronger second half of the year. And again, we're beginning to see investment volumes return, liquidity return. And again, online retail isn't going anywhere. It's in a period of flux. But I go back to that demographic point I made about online retail. And we have this additional driver, nearshoring, reshoring. I just want to be clear, though, on that. That is going to mitigate for a fall in demand from online retailers. It's not going to replace. And also, this is a decade play. It's not the quick explosion that we saw with online retail. So it's going to have an impact on the market in a different way.